Good evening, everyone. Today is February 10th. Time for our daily breakdown of the 3 major US indices, plus a few names on our watch list. If you're getting value from these updates, make sure you're subscribed. Today's tape was pretty muted. The market had a clear defensive tone, nothing aggressive, no real risk on push. The Nasdaq pulled back slightly after the rebound we saw over the past 2 sessions. We're essentially in a data blackout window right now. Tomorrow we get non-farm payrolls, and we're heading into a heavier macro data cycle. So today felt like positioning ahead of catalysts. Lower conviction, lighter volume, traders not wanting to press bets. This minor retracement is still tied to the overhang from the recent AI-driven shock to software names. That narrative hasn't fully cleared. On top of that, we saw the launch of a new AI-powered tax planning platform. Not exactly breaking news, but it's another reminder that AI is moving directly into consumer finance, tax optimization, and data aggregation. That puts incremental pressure on traditional personal finance software providers and data vendors. In other words, the fear isn't gone. Right now, the market feels split into 2 camps. One side argues SaaS is safe. AI is just an enhancement layer. It boosts productivity, expands margins, and strengthens the moat. The other side believes AI is fundamentally deflationary for software, that over time, many of these tools get commoditized or outright replaced. Which side are you on? Here's my view. Long term, I believe most software will eventually be disrupted or replaced by AI in some form. That's not controversial, it's just a matter of timeline. Maybe it's 10 years, maybe it's 20. The exact timing is impossible to model with precision. So instead of debating the unknowable, we focus on the primary trend. And the primary trend in this cycle is clear. AI is the dominant macro theme. AI infrastructure, including semiconductors, remains the core leadership group of this bull phase. Now, outside of the core AI semi-trade, there are selective opportunities. Yesterday, we talked about Tesla as a longer-term allocation idea. At those levels, near technical support, the risk-reward made sense for scaling in. And as expected, we've now seen 2 consecutive green sessions. Companies like Tesla are interesting. They sit slightly outside the pure AI semiconductor trade, but they're still connected to the broader innovation theme. Why? Because Tesla may look like just an electric vehicle manufacturer on the surface, but in reality, it's also an AI company. All of its full self-driving capabilities are built on large-scale AI models tied to the XAI ecosystem. And if you've actually driven a Tesla, you know this. The entire vehicle experience is increasingly AI integrated. With Grok embedded into the system, AI is becoming part of the full in-car architecture. So yes, Tesla absolutely qualifies as an AI name. In that sense, it belongs to the primary trend. But it's also outside the main theme because it has opened up another path. Right now, in terms of overall technology, humanity has reached an AI inflection point. A fork in the road. The other branch is the path toward extraterrestrial civilization, including aerospace and space transport businesses. That's another divergence, another primary track. So Tesla is a company with long-term investment value because at the end of the day, it represents a very important point of interaction between us and the physical world. Now pay attention. You've seen the Dow Jones performing very well. After breaking above 50,000, we're now seeing signs that it may come back to retest that 50,000 level. There was a long upper shadow, what some call a shooting star. There's no need to panic. The pattern hasn't fully developed. You can't look at 1 or 2 candlesticks and conclude that this is a top. There's no need to worry about that because what does the Dow represent? It represents traditional American blue chip stocks, legacy companies. And here, you just need to hold on to one core idea. Look at the primary business of the stocks you own. Do they interact with the physical world? Before AI and robotics reach full-scale mass production, any business that interacts with the physical world and is not easily replaceable is worth paying attention to. Let me give you an example. Coca-Cola dropped very sharply today. It sold off hard. But what is Coca-Cola? It's a major representative in the consumer staples and beverage space, a long-standing blue chip. What does it mean to interact with the physical world? It means I have to physically drink the beverage. That action cannot be replaced by software or code. AI cannot replace the act of drinking water. Now, of course, consumer preferences can change. Maybe people decide they don't want sugary drinks anymore. But the company adjusts. Zero sugar Coke is now selling even better than the original formula. So as long as a company's core business interacts with the physical world in a way that cannot be replaced by AI, it deserves closer attention, especially if its earnings remain solid. Yes, Coca-Cola's latest earnings report had some issues this quarter, but that doesn't change its long-term investment value. If you're looking for a more defensive long-duration allocation, planning 20 or even 30 years out, then you can learn from Buffett and look at these types of legacy names. These are companies that, regardless of market cycles or technological shifts, are not easily replaced. Now, the AI-related names we're trading today, is it possible that these companies get replaced in the future? Absolutely. It's very possible. They could be replaced by a new service, a new framework, or a better solution because they are not directly tied to human interaction with the physical world. They operate at the software and infrastructure layer, but at the same time, they are the current primary investment theme. And when something is the primary theme, you have to hold it. That's what delivers strong short to mid-term returns. Will the bubble burst? It will. It absolutely will. Remember that. It's not a question of if, it's a question of when. Our job is to exit before it bursts or during the early stage of the unwind. That's it. We often use this analogy. When eating a fish, we leave the head and the tail to the market. We only take the middle portion, the most profitable part of the move. That's the strategy. Now, as for today, there wasn't much in terms of major macro or fundamental news. Nothing significant enough to put on the table and dissect in depth. So we'll mainly do a quick review. We've consistently said Tesla is a strong mid to long-term investment candidate. And going forward in our daily updates, we'll continue sharing both emerging tech names and traditional industrial or legacy plays, giving you exposure across themes. Today, I want to share a name, Datadog, ticker DDOG. Datadog is a leader in observability and data monitoring. In today's environment, every company, whether it's a traditional enterprise or a high-growth tech startup, depends on server infrastructure monitoring. And now AI is layered on top of that. How many tokens are being consumed daily? What's the throughput? How many queries are being processed? Is the model hallucinating? Is latency increasing? All of that requires monitoring. As AI adoption scales, the demand for real-time observability and visualization tools continues to grow. That structural demand directly benefits companies like Datadog. Within this space, Datadog is a clear standout. After earnings, the stock delivered a strong report and gapped higher. On the weekly chart, it's still trading near the lower end of its consolidation range, which makes this zone attractive from a risk-reward perspective. This is a name worth adding to your watch list. In my view, a reasonable accumulation range is between $110 and $130. That zone allows for scaling in. If it breaks below the prior low around $105, then risk management becomes important. At that point, we would need to reassess the business, the earnings trajectory, and the broader macro environment. Personally, I don't see that scenario as highly probable right now. So between $110 and $130, phase positioning makes sense. Take a look at DDOG. The UI is extremely well designed, very intuitive and clean. If you're interested, visit their website. Most retail investors won't directly use the product since it's enterprise focused, especially among startups and smaller tech firms. It provides deep visibility into servers, databases, applications, AI integrations, and large language model performance. The execution quality is strong. Overall, it's a high-quality company in a structurally growing space. Definitely worth monitoring closely. All right, that's it for today. Now we wait for tomorrow, February 11th, and the data release. One more point on that. I've seen a lot of media outlets already publishing their expectations. Personally, I think tomorrow's numbers will likely come in around expectations. What does in line with expectations mean? It means U.S. employment data will show signs of slowing. It has to slow because of AI's impact. I've consistently held the view that the Fed and U.S. policymakers are underestimating the structural impact AI is having on the real economy. The most direct impact shows up in the labor market. If you rely purely on employment data to set fiscal and monetary policy, I think that could create serious problems. That's why I actually agree with some of the recent comments from Waller. The idea of continuing balance sheet reduction while discussing rate cuts. It sounds like a strange combination. Rate cuts plus QT. But I think there's logic behind it. You can't rely too heavily on traditional data to guide policy anymore. The environment has changed. Employment isn't influenced solely by economic policy or corporate financing costs. It may be influenced by entirely different forces, like AI. So regarding tomorrow's data, I believe the market has already partially digested expectations. Now, digested doesn't mean the market will rally once the data is released. It could still pull back and continue testing support levels. From a technical standpoint, the Dow is very likely to test the 50,000 level as support. Remember that. The Nasdaq will likely continue testing the lower bound of its range. We saw the lower channel lift previously around 22,450, so it may revisit somewhere above 22,450 to look for support. If that level breaks decisively, then we could be talking about a potential topping structure. If it breaks, the bubble could deflate sooner than expected. Don't focus too much on the S&P 500 right now. Watch the Nasdaq and the Dow. Why? Because the S&P is technically too clean. Even if it pulls back, it's still trading within its ascending channel. It doesn't give you a clear signal. A dip there doesn't provide much actionable reference. So the key is this. Can the Nasdaq hold above roughly 22,460? That's the level to watch. As for tomorrow, my base case is continued downside pressure. There's a high probability all three major indices close red. Why? Even if the data comes in as expected, the market still needs time to digest it. That digestion process happens through rotation and churn, through volume and repositioning. That's it for today. You can share your current holdings or stocks you're watching in the comments. I'll select a few to review with my team. You can also join our community for real-time discussion and market updates. Make sure you're subscribed. I'll see you in the next update.